Welcome to the first episode in our Future of Mobility series. Today we are joined by Elisha Jacobs, Senior Associate at Future Mobility VC RedBlue Capital. I'm also joined by guest co-host Julian Gio, a first-year at Wharton who worked in strategy at VIA prior to the MBA. In today's episode, we delve into the expansive world of future mobility, exploring the variety of startups shaping this dynamic sector and examining how venture capital is engaging with these innovators to drive forward the transportation revolution. Hi, Elisha. So happy to have you on the podcast. Could I ask where you're dialing in from today?
Yeah, thanks for having me. I'm in Manhattan, New York.
So in simple terms, what is RedBlue Capital and what is your role there?
Sure. So we focus on transportation and mobility businesses. So moving things from point A to point B, both goods and people, both hardware and software and things connected to them. So we are a early stage investment firm focused in that area specifically. And I'm a senior associate and one of the two members of the investment team.
Awesome. So what tends to be your main investment areas, or does it tend to be like very broad within kind of the mobility sector?
Yeah, so we see a benefit to being in one sector and knowing all the investors and all the companies because we can be super collaborative with companies we're investing in and investors we co-invest with and can get really deep and meet all the people in the segment that we're working on. But simply put, our main focus, when evaluating companies in that sector, which is quite large, is whether or not they have a very large market. So, many billions of dollars they can reasonably develop revenue in. And that's not to say that, companies that, can't be unicorns aren't worthwhile, just that our specific venture capital model only works if a couple companies from the portfolio can become highly valuable. So that's what we put our focus in. But from a product and customer perspective, we see the theme of regulatory pressures around electrification or emission reductions and total cost of ownership or TCO as, major drivers for a company that's going to be successful in this market and a major theme in the electric transition. You've probably heard of TCO before when it comes to EVs. So that's like no gas or less maintenance and much cheaper since there's no engine over the full lifetime of the vehicle. And, that tends to work really well when vehicles are the same starting price, but gets a lot tougher when you're comparing, a Tesla Model S or a Lucid Air to a cheaper or a more efficient, gas car, which is never going to, win on TCO.
I wanted to follow up on, you described your model or interest is focusing on or getting a lot of understanding the sector very well and being collaborative. Could you elaborate on what you meant by collaborative in this context?
Yeah, so we're a seed fund and we don't lead, we specifically co-invest. So that means that we're working every time with other venture capital funds doing deals. But at the same time, because we're sector focused and, both my partner and I have a rich background in this space, we have pretty strong networks and can bring a lot of value from our networks to the table to the founder and the founding team of the companies that we're investing in. And, there are a lot of examples of that. But yeah, for example, we are talking to a company that's doing something in the tire space, and we just introduced them to someone who was very senior at Goodyear, which is the biggest tire company in the world. And, a lot of examples like that, basically, where our network plays a big part in our oversized value that we add, even though we're kind of an undersized check in the total round composition.
How have the members of your team gone about building that network, or what backgrounds do you come from that's facilitated that?
Yeah, so I'll give you my partner's background. His name is Olaf Sakers. He ran two funds out of Maniv Mobility in Tel Aviv before starting RedBlue. So RedBlue is technically a solo GP emerging manager fund. This is his third fund and his first, solo GP fund. And my background is from both the banking side and the operating side in mobility and in energy transition. Happy to talk more about that if that's helpful.
I'll dive into that probably a little bit, but one more question along this vein, or one more, introductory question is, what are some of the more exciting deals or deals you find more exciting that you've done recently?
Yeah, so like I said, everything touches that A to B concept, but it can really fall into different ends of the spectrum quite easily. So like For example, our inaugural investment, which we made a couple of years ago, was in an aviation technology company that can dramatically reduce the cost of moving freight and expand the relevance of air logistics. So, in spite of the magnitude of the impact that it makes, it appears to be the most streamlined path to regulatory certification and approval, as compared to the eVTOL players and other advanced aerial mobility out there. And basically what they're doing is they're developing an unmanned glider trailer to allow a variety of standard manned aircrafts to safely and efficiently tow significantly more weight than they can carry on board their airframes. So in layman's terms, it's basically analogous to like hooking a tractor trailer onto a truck, but just in the air. So what that does is it reduces the cost per pound of air freight pretty significantly, obviously. And it also, substantially saves on a fuel per pound moved, which allows air cargo to reduce its carbon footprint without needing, complex energy storage or propulsion mode upgrades. And it also allows, air freight to become quite competitive, when moving goods, which otherwise would be typically done in trucks or on the ground. So that's like all the way out there, super kind of like a funky story, but a very strong founding team from Amazon. And I would say that that represents kind of one side of the business that we're looking at, which is, reducing emissions and reducing cost per pound. But then for a bit of whiplash, the other side of the market, we're investing in a company that basically builds purpose-built e-motorbikes for delivery, courier, ride-hail drivers launching in Nairobi and other parts of East Africa, but primarily built for like the global south, which needs a lot stronger wheels for dirt roads and a lot more capable chassis because these bikes carry either lots of goods or lots of people. Like imagine a motorbike going up a steep dirt hill with a ride-hail driver and two passengers on its back. So it's definitely a different form factor than what we're used to in New York or in Philadelphia. And not only that, but they're also building a battery swapping network similar to like GoGoRo, which is the Taiwanese company that developed a battery swapping refueling platform for urban E2 wheelers, so scooters, mopeds, motorcycles. So a very similar model in that sense. But what this ultimately offers are, pretty superior economics to the incumbent motorbike most commonly used by delivery drivers, which is, a diesel vehicle. So like basically that idea of total cost of ownership or TCO, like I mentioned before, comes into play here because a retail diesel motorbike that people in that market typically buy costs around $1,500. And if you're going to buy the e-motorbike with a battery, it costs well above that. But if you detach those two assets and you make the bike the thing that the consumer buys and you offer a battery as a service subscription, you begin to, over the lifetime of the vehicle, really aggressively cut on that TCO. And it can come to nearly 50% savings for the driver. So I think those two kind of represent either ends of the market of what we're looking at. We typically will invest in companies in America and Europe, but from time to time we see very exciting opportunities around the world and are comfortable, building out our relationships and networks to make those investments. I think another interesting deal, which is also kind of like neither in, advanced air freight or in electric motorbikes in Africa, so kind of representing another side of the business that we're looking at, is we're working on a deal with a company that's building out the largest EV trucking fleet as a carrier. So in the logistics value chain, so for the short haul segment, which is below 250-mile trips in the US. So I don't know how familiar you are with the logistics segment, but they're the shippers, like Pepsi, who want to ship their cans of soda, and then they're the carriers who actually make those trips and bring the contract and the drivers and the vehicles together to basically move that good. So this is a business that's basically building a fleet of electric trucks to deliver those goods. And it's a huge market, the short haul truck market. So just the sub 250-mile trips is over $150 billion in the US and growing. But there are basically no zero carbon options for corporates that are trying to reduce their emissions. And there are a lot of those. And so not only are corporates electively setting, I should say, ESG goals for themselves, but there's also regulation and incentives which are beginning to become pretty widespread for shippers to push for them to use electric carriers. So, that has to do with, a lot of it has to do with, California legislation, but I think we kind of often see California as a first mover in this space and see other states begin to follow. Yeah, so those are kind of three representative companies that, I think are pretty interesting.
Awesome. Really exciting companies. And I think it kind of is a window into maybe like the interesting world of mobility investing, especially from the VC side, given that a lot of the businesses you tend to invest in are very hardware focused in comparison to, the often SaaS focused VCs that we see elsewhere in other sectors. Given sort of like the recent raise in like interest rates and sort of like the challenge of getting funding and capital, how is that sort of like maybe capital intensivity of hardware companies in the recent rate environment maybe changed the way you thought about investing? Has it made it harder, or has it maybe made it sort of like easier in the sense that if someone is starting a hardware company in this environment, they are clearly a great founder and have a great product?
Yeah, that's a great question. So from my time at Revel, which, was a business 100% built around hard assets, whether those were mopeds or bikes or Teslas or charging infrastructure, it's kind of like the whole gamut of hard assets you could imagine. I definitely built some thick skin around thinking around this. And I think most VCs that I interact with typically want to invest in asset light software companies, software as a service businesses, selling to enterprise, sort of that typical VC outlook that have, zero CapEx and spend all their money on, hiring engineers and Amazon Web Service bills. But I think it's really cool to do that, but it's just not exactly what enables this specific industry in a big part. So like think about who the biggest wins that have created, many hundreds of billions in shareholder returns in this space in the last decade. For EV, you've got Tesla, Lucid, Rivian, Arrival, Nikola in China, NIO, Xpeng, et cetera. AV, Waymo, Cruise, the trucking companies, Too Simple, Aurora, maybe not Too Simple anymore. And, micromobility, Revel, Zumo, Rad Power Bikes, Bird, Lime. So I'm not saying that all of these are still successful, but these companies created hundreds of billions in shareholder returns. So ultimately, I think it has to do with, building out strong data sets, because you're not going to be able to raise, say a $50 million debt facility from the pre-seed or seed stage on an idea. But at a certain point, if you have enough miles under your belt, and I think we were able to accomplish this at Revel once we raised our Series A, basically, those debt players can get a lot more comfortable with that type of risk where they typically wouldn't any earlier. So while RedBlue isn't the ones providing the asset financing, debt capital, we're able to take a bet on the companies we invest in being able to access that scale-up capital from the different players, like Apollo, which launched its clean transition capital strategy with I think a $50 billion goal, or BlackRock, which is on its fourth global renewable power fund for $7 billion, or TPG's Rise Fund, which is also around $7 billion impact investments. So all of these, and there are also a bunch of smaller players too that are comfortable taking on that risk, but they're all kind of falling into that asset class that we tend to partner with and look at when we're looking at asset heavy businesses.
So in some sense, you're almost like investing in like the pure idea and product that startup is creating, as opposed to maybe some of the actual assets, which you then are sort of almost being financed by some of these other providers in the space. Is that maybe sort of how you see it? Like you're almost disaggregating the two parts of the business?
Yeah, I think we like to call it the pre-product market fit. So we're investing with the bet that there will be a product market fit for the business, but there is already a product, whether it's a prototype or it's a business that already has some revenue coming in. But we're investing pre-scale up phase. That's in the seed. So we're betting that they're able to scale up. And once they're able to scale up, at least in some way, that's when they're typically able to access the asset financing capability. Whereas, without really any data set, it's very hard for kind of a bigger or, institutional asset player to come in and finance a company that early.
Awesome. Another interesting element, I think, in sort of the mobility space, and is probably actually really relevant for some of the companies that you highlighted that you're quite excited about, is the regulatory environment. Unlike in typical B2B SaaS, right? So much of this product market fit, in addition to there actually being a commercial product market fit, is the regulatory space to allow some of these solutions. So, will the FAA allow for these gliders to be attached to cargo planes and so on and so forth? How do you guys think about maybe underwriting sort of some of this regulatory risk, or like how do you potentially evaluate that in your investment decision?
Yeah, I mean, I think that my experience at Revel was very relevant in this because when I joined Revel, it was really in that time where Bird and Lime had, taken the approach of dumping 1,000 scooters on the sidewalk overnight, taking a page out of Uber's move fast and break things philosophy. And Revel was kind of the opposite with a regulatory first strategy. And I think that influenced me a lot. And I think, about that a lot when I'm evaluating companies today. And I think that has actually really worked out for them in a number of ways. But, in an environment where there are so many regulatory headwinds and tailwinds at the same time, you sort of can't ignore it. You need to pay attention to the moves that are being made, whether it's state or federal. And often that affects the end consumer because, in the case of electric vehicles, there are, a bunch of incentives to purchase EVs, or in the case of zero emission trucks or EV trucks, there's real regulation that's coming out that's going to force basically truck manufacturers to sell an increasing number of EVs starting, almost next year. And then eventually, that will become pretty widespread across the country. So it's sort of baked into everything that we do. One of the, many categories that we look at when we're looking at a company is the regulatory environment that they're in and whether that is a headwind or a tailwind, because it really can be both.
Just to follow up on that, I feel like in a lot of the mobility sectors, especially regulation is such a huge barrier. Has that been particularly adjusted by some of your investments in abroad in Africa, outside Europe, the US, where you see a little bit more freedom? Is that part of the impetus for investing in those areas?
No, I wouldn't say that there's more freedom in areas outside of the US. I think, for example, we're seeing in Africa and India and in that area, a lot of government incentive to push manufacturers and operators and, drivers to transition to electric. And, there are the famous subsidies in India and higher fuel taxes and EV incentives in East Africa. So I think there's a lot of regulatory and policy, risk and tailwind on both sides that comes into, making that kind of bet. But another example is in Kenya and Uganda, there are import duties and they tax non-domestic vehicles. So that's another kind of thing that we have to think about when we're underwriting an investment. So it might not be something that we're super familiar with to start, but it's something that we definitely need to wrap our head around before, making that investment.
Interesting. Thanks. I was just curious. I visited the zipline facility in Rwanda recently, and that was part of their impetus for starting there. But I guess it's not a blanket statement for all sorts of mobility.
Right.
So I know one of the main theses that your general partner had is around sort of the trip economy and the fact that a lot of people maybe don't have a wasted asset, let's say, but maybe an underutilized asset in their driveway in the form of their car. And that this creates a lot of negative externalities on society, and from, extra requirements for parking, these big heavy vehicles that are capable of traveling, hundreds of miles, but don't actually do that on a fairly frequent basis. And that came sort of up with the idea of the trip economy or the sharing economy. Could you maybe sort of dive a little bit into what that actually is?
Yeah, that's a great question. And the context is my partner Olaf wrote a book called Mobility Disruptions Framework. Shameless plug is you can actually find it online at yellow.cab, which is a URL I'm still shocked was available, which in the first chapter discusses the idea of a trip economy, which basically breaks everything about car ownership and compares it to the trip economy. So car ownership meaning purchase price, insurance that you pay every month, fuel that you pay, a couple times a week, fines, parking, maintenance, even things like opportunity cost that you have by having to sit behind a wheel in traffic, and compares them to the trip economy, which is basically everything you'd ever use a car for, but from a per trip lens. So an example of this is instead of driving your owned car, the car that you bought to the grocery store, there's the rideshare option where the Uber takes you back and forth, or there's the Instacart option where, the trip itself gets delivered and also the action is taken of picking the groceries. So those are both the end consumer paying a single price for that trip or that action being made. And I think as cities become more congested and smaller vehicles, maybe become more faster or more effective, this kind of comes up because this was sort of the thesis around the Revels and the Limes and the Birds although ultimately those are very challenging businesses to run profitably because you're dealing with expensive assets that depreciate rapidly, often much faster than any owner or asset financing provider is willing to admit, mainly because the end consumer doesn't really care for the vehicle as if it were their own. So are comfortable, dropping their bird scooter or tossing their Lime scooter into the river. But what's nice about the trip economy is that not all trips have to be a smelly Uber pool or a shared by hundreds of thousands Lime scooter on the streets of Austin. It can also be, a batched order from DoorDash that efficiently routes between a few stores that are maybe highly trafficked and delivers several orders to a general area at the same time, which ultimately reduces the cost of and, the emissions from that trip. So I think a good example of this that I'm particularly a fan of is the company Toro, which is the peer-to-peer business closing in on hitting the public markets. Is a pretty later stage company at this point, but it attacks that problem that you mentioned of, your car basically sitting in your garage depreciating, because that idea of car ownership is super inefficient because ultimately you buy your car, it immediately loses like a quarter on depreciation from just rolling off the lot. And then it basically sits in your driveway or your garage or in your parking space, depending on where you live. And, what does it do? It rusts, it drips oil, and it depreciates as time goes on. Only a tiny percentage of the car's actual life is spent with you driving it. And so what the business that Toro's built is really around enabling higher utilization for this asset that you own, which is, basically the same idea as Airbnb, but for cars. So, let's say you go on a trip somewhere far away and you won't be home for a week, it basically allows you to generate revenue to effectively offset that depreciation. And I think that's like a really direct example of this. But another, I think, interesting example that you might not think about immediately when you talk about trip economy is the idea of like battery swapping. Battery swapping can fall into the category too, because instead of owning your own battery, which is by far the most expensive component of an electric two-wheeler, plus you need to maintain it, you need to actually charge it, which takes a lot of time, and you need to, ensure that it doesn't burn your house down. You can pay for a subscription to a model that offers you batteries fully charged on the go. And that kind of falls into that category too. So obviously I mentioned the business in Nairobi doing this, but the same sentiment exists here in New York, where you have tons of delivery drivers riding e-bikes around the city, typically aero bikes, and they typically use something called a silverfish battery. And right now there's sort of this under the table black market battery as a service business where they pay restaurant owners to charge and stow their batteries in their basements around the city. But, there are like a million wires everywhere and it's super dangerous. So the city's beginning to clamp down on that. And there are a few companies working on a similar to what I mentioned before on the Gogoro side, clean battery swapping solution for this market too. So the point there is, it really touches a lot of things that you might not expect, but can make ownership more efficient in certain senses.
Totally. That's a super interesting way to sort of think about how people actually get around. But I think, maybe zoning in a little bit on the Turo example, I think what's really interesting in maybe cars, and I think this applies to the way people buy things writ large, is that consumers are inherently emotional, right? And there's this very emotional attachment, especially in America, to having your own vehicle and being able to like take to the road whenever you want. Do you think there will ever sort of be a stage or a point in our economy and our society where people are truly willing to give up maybe that personal or private ownership of a vehicle and, make that more economic and rational decision to share their assets when it comes to taking trips?
Yeah, I think that's a very fair point. And I remember in like 2017 when I started working, or maybe it was 2016, Elon announced his second master plan, which included the concept of your personal Tesla, when not in use, becoming a robotaxi. And, that would generate income for the owner. And there was also at the same time, Cadillac announcing the Book, which was supposed to be a monthly car subscription service, kind of like Netflix. And, neither of those things have happened. And I totally agree with you on consumer sentiment. But I think what's interesting, and this is sort of like a different topic, I would say, but I think what's interesting is consumer sentiment really shifts based on the market that you're sitting in. And I think I've seen this most recently in a different segment. So we've recently spent some time learning about the micro car space, which has a few companies out of the US building prototypes, but obviously a lot more success in Europe with the Citroën Ami and the M-Crow Microling, I don't know if you're familiar with those. And the rest of the world, like Japan's K-trucks, which you actually do see in some states in America. And this idea of a smaller pickup truck, whether EV or not, makes so much sense. There's so much waste in the US when it comes to vehicle size, and it's not even all functional. At least a quarter of the vehicle is in the hood. And so when it's electric, that part is basically replaceable. And the idea is that people that drive Ford F-150s have a hard time finding parking in cities near their construction site because of how massive their car is. And, it might work in different parts of America and more rural parts of America, but in major cities where there's a lot of construction, it's very hard to actually park right by your site in a massive truck like that. But I think there is a market for this. And, that market, like I said before, are the Europeans or across the world that are kind of willing to make that transition or to have never made the transition into the big whopper of vehicles. But there's a difference for Americans between small, like the Ford Maverick and the Toyota Tacoma, which make up 25% of US pickup sales, and then mini, like the size of a Mini Cooper for a truck. Yeah, Americans don't love that very logical concept around less is more. And I think that's one that I'm hoping wins, despite us not getting a ton of conviction around it for that reason, around, American consumer sentiment. And likewise, I think it would be great for us as consumers to get more comfortable with, sharing our assets. But there are some things that Americans, just do differently than the rest of the world. So as an investor, you also have to be kind of level-headed about that kind of stuff.
Totally. And I think even if we think about even smaller in terms of micromobility, with whether it's e-scooters or electric bikes, there's probably even further to go in the US from an infrastructure standpoint. I'm sure with Revel, I guess you guys were in the Vespa industry, but I think a lot of people are probably reticent to adopt an electric bike or an electric scooter because they have to ride on the main road, which has a ton of these huge, scary vehicles on it. So clearly a lot of barriers, even beyond sort of the emotional ones, to adopt maybe some of these other forms of transit. So
yeah, totally. I mean, the cities that we live in are built for cars. And that's a decision that was made, 100 years ago and then doubled up and tripled up throughout the last, 50 years. It might be that we're living in a time now where we are able to use a certain modality for the, urban environment and then a separate modality for the suburban or the rural environment. You kind of have to break the mental model that we've all grown up in and the global industry exists in and try to see it differently. But it obviously takes a lot of infrastructure investment and overall investment into that transition. And I think that was where a lot of the motivation for the Birds and Limes, back in 2016, 2017, starting out came from. But it's obviously a very challenging business. So you kind of have to balance both the idealism with the realism of, operating a profitable business over time.
Asking more about VC specifically, concretely, what are some of the key characteristics you look at in a company while investing in kind of these higher tech companies at a pre-seed stage? I'd especially love to hear what might be different from VCs in other industries.
Okay, so what we look for in an investment is a couple things. I think I would assume I can't speak for the whole industry. I would assume all VCs look at these things. And the first and most important is the founders, their quality, their ability to storytell, and ultimately their ability to raise future capital based on all of that basically combined. And then obviously, like I mentioned before, we look at the market itself and the addressable market and the obtainable market that it can fit into and the ability for it to scale quite large, because in every VC portfolio, you're only going to get a couple big winners. So you need to make sure that when each of those companies can win in a way that can return your fund. And then, around the solution or the product having high novelty and high usefulness, around the product having a real market fit, and the go-to-market strategy, not being too capital intensive, having low CAC spend, having a strong regulatory framework like we spoke about, having strong sales channels and the founding team having connections to those. And then, all around making sure that we understand the moats to the business and any competition that exists in the industry too. But I think there are a lot of different types of investors. And venture capital is only one of the asset classes you can invest out of. But within VC, a good framework of thinking about distinctions is generalist versus specialist, and we're obviously a specialist. And I think the way that we think about what makes a good venture capital investment is we think about deals on basically a 4-quadrant diagram. So the y-axis is like hot or not hot, and the x-axis is good deals or bad deals. And often companies fall into that hot and bad deal quadrant. Sometimes they fall into the hot and good quadrant, which makes having a strong network and relationship across the industry helpful, both for access and for diligencing. Most deals out there are in the ugly space of bad deal and not hot. But the best deals are the ones that are on that last quadrant of not hot, but very good. And those require the most work because you end up having to take a contrarian perspective of why is no one else looking here and what are they missing? And you're ultimately forced to have conviction in the market, versus your peers. So, to break those out, you have a strong sourcing mechanism, being comfortable being a contrarian, and being comfortable building conviction.
So from a careers perspective, we probably have a few listeners, actually definitely at least one, because I'm interested in this, but what sort of skills would you suggest someone from the MBA or from undergrad look to develop to get into mobility VC?
I think in order to get there, you need to be able to establish solid flow. And that comes from developing mutual relationships and networks, which you're able to provide and gain value from, in the form of intel or trends or companies being formed or personnel changes, and the list goes on. But I think it ultimately comes back to the idea of finding a passion and working within that. And once you're able to do that, you can develop all of those things I mentioned. So I think what's most key is finding a vertical or an industry, you really are excited about and go get real experience in that. And I think there are different methods to that. There's joining an early stage company that's successful and acts like an elevator for your career, but obviously brings considerable risk. And then, there's joining a later stage company, which offers less assorted hat wearing. So maybe your hands aren't as dirty, and your learning experience isn't as intense, but maybe a good understanding of what the startups that you'll be investing in later on should grow toward and become, and, have their eyes set on from a corporate governance or structuring or culture perspective. And plus, you often get to work with other big players in the ecosystem, so can develop out your network that way, which is crucial in venture capital.
That makes a lot of sense and is in line with many of the things we hear. One last final question for those looking to be VC investors or those looking to just get the job in the industry. What are the new technologies or trends that you're most excited about that you suggest people should learn up on or maybe find jobs doing something along those lines?
I think there are a bunch of cool companies right now that we're seeing. I think it's a very good time to be investing in this market in our space. But I think two of the most interesting things that we're seeing, one is around hybrid trailers for Class 8 trucking space. So it's sort of related to one of the companies that I mentioned before. Instead of fully electric trucks and trailers that, like the Tesla Semi or the Volvo VNR or the Nikola, this is hybridizing that approach. So basically, commercial trucking is responsible for a third of transportation emissions. And what this does is it basically creates an electric axle that's attached to a battery and then connects that all via a smart, what's called kingpin, which is connected to the tractor. And it allows a Class 8 truck to lower its diesel consumption by, 35% without changing the infrastructure that you're already using or spending several $100,000s on that Tesla Semi. So I think that's one space that obviously has a lot of regulatory tailwinds, and there are a couple companies coming out of that right now. Probably the biggest one is Range Energy, which just raised a round. And another trend is around introducing robotics and autonomy in constrained environments. And that basically reduces the cost of labor to overall operations. And I think there are two cool companies that we've been learning more about. So one company is offering an automated trailer for loading and unloading that can handle up to 20 pallets at a time. So when a business is unloading or loading a truck, it'll typically use a human operated forklift, which can, safely pick up 1 pallet per minute and then place it onto the truck. And so that ends up taking, around 25 or 30 minutes typically. And what this system does is it reduces that time to 5 minutes because it can carry up to 20 pallets at a time and is unmanned. So because of that unmanned approach, they estimate a payback period between, 1 to 6 months due to labor reduction. And the other company provides a similar value to the business that it sits in. They're building a tire swapping robot for fleet maintenance shops. And, those are also constrained environments. And that product basically reduces the human touch points from over 10 to around 2 and reduces what could be a 4-hour wait and repair time for 15 minutes because, between inspection and authorization or waiting on an open bay and the actual repair time itself, this can take a lot of time and introduce a lot of inefficiencies. And so that company sees a payback period of, just 2 months and a gross margin increase of almost double for the tire shops that it sits in because of the reduced labor and greater output ability.
Well, these really, I think, highlight the diversity and the different options within the mobility sector, which we've been just covering throughout this interview. Do you have any last words of wisdom or last comments you want to make?
About anything specifically?
Anything that you might find interesting or anything you want to share?
In general, I think there's a bunch, especially since there's a solid chance Trump comes back, or, not solid, but like around 50%. And that can mean a lot for the EV industry, and we're already seeing that with a states divide between Republican and Democrat states on EV taxes to make up for lost gas tax revenue. So I think there's a lot there. But I think my mind right now is on China, especially after today's announcement that the House approved a bill with kind of a comically specific title called the Protecting Americans from Foreign Adversary Controlled Applications Act. And that's basically supposed to force ByteDance to divest TikTok or have it banned in the US. So around China, I think China's, facing some very interesting aggressive headwinds and will be doing so for the next few years. On a macro level, the Chinese economy is slumping, and there's research coming out about the demographics crisis driven by their one-child policy that's, infamous, that basically says that the fertility rate is approaching 1 birth per woman, which is half the current replacement rate, which is supposed to be around 2 or like 2.1 or something like that. And those researchers are basically saying that the population is going to drop basically by, to like around 500 million, and it's at 1.5 billion now. So I think that's going to change the dynamics of manufacturing and export and any tariff wars, any potential Trump presidency could bring back. And then on the other side, the Inflation Reduction Act, which was passed by the Biden administration in August of 22, it basically aimed to reduce emissions in the US by accelerating the transition to clean energy. And it had dozens of incentives to develop the clean energy markets, including the EV ecosystem and supply chains. And it was filled with requirements that limit eligibility from what they called like foreign entities of concern and preference companies that were building in North America, including Mexico. And so what that did is it basically incentivized Chinese electric vehicle manufacturers to develop joint manufacturing ventures with Mexican companies to bypass the North American rules and export into the US. But I think what dovetails interestingly is we might see policymakers try to block this with a similar strategy around how they are blocking TikTok or ByteDance and Huawei over the last few years, which, basically invokes some security concern around interstate commerce. Because ultimately, what are EVs, right? They're obviously cars, but they're also cameras and sensors and, battery management system, a BMS, telematics, they're a GPS, and they're all connected over the air updates to the cloud and back to their headquarters. And if the vehicle is Chinese, the headquarters are in China. So it's pretty similar to an issue with a microphone and a camera and demographics data from TikTok in kind of a way that I think we might not expect. I realized that you didn't ask a question about regulations or China, but that is something that I've been thinking about. So I did answer your question.
No, I like that. It's always worth remembering that we're in a global context. There's so much going on that could impact this industry in specific, or in particular, as well as so many other industries. And I'm also a China watcher, so to say, so always interested in these topics. But to wrap up there, Elisha, it was so great having you on this podcast episode. I think it was a great introduction to the different aspects of what is a surprisingly complex sector. So really appreciate your time.
Yeah, my pleasure to be here. Thanks for having me.
Thank you.